If you have more than $10,000 or ever plan to touch it, you need to hear this before it costs you everything. There's a rule your bank will never warn you about, a rule the government enforces automatically, a rule that has already trapped thousands of honest seniors, people who did absolutely nothing wrong. No crime, no fraud, no bad intentions. Yet their accounts were frozen, their money was seized, and their lives were turned upside down simply because they didn't know how this rule works. If you're retired, close to retirement, helping family financially, or planning to move a large amount of money at any point in your life, you cannot afford to miss a single minute of this video. Because by the end, you'll understand the $10,000 rule, how it really works in 2026, and how to protect yourself before the system puts you on its radar. Before we go any further, let me say this. Michael Visa Guide is for people like you. It's for seniors, retirees, and hard-working Americans who played by the rules their entire lives, but were never taught how the modern financial system actually works. If no one has ever explained this stuff to you clearly, honestly, and without scare tactics, that's why this channel exists. I'm Michael, and I regularly upload videos breaking down topics like bank rules that catch people off guard, IRS letters and what they really mean, protecting Social Security and Medicare, cash transactions, inheritances and family gifts, and financial mistakes that are easy to make but hard to undo. So if you want information that's explained for you, not Wall Street, not big banks, subscribe now and stay with this community. I'll be uploading more videos on this exact topic and related rules that most people never find out about until it's too late. Hit subscribe, stay informed, and let's make sure you never learn these lessons the hard way. Now, before anything else, let me make one thing very clear. This video is for educational purposes only. I am not a lawyer. I am not a certified financial advisor, and nothing in this video should be taken as professional legal or tax advice. Every person's financial situation is different. What I'm doing here is helping you understand a rule that the government and banks quietly operate by, a rule that most everyday Americans, especially seniors, were never properly taught. So please, after watching this, consult with a licensed tax professional or financial advisor who can look at your specific situation. With that said, let's get into it. So what exactly is this $10,000 rule? Well, it's actually called the Bank Secrecy Act, and it's been around since 1970. Yes, this law is not new. But what is new is how aggressively it's being enforced in 2026 and how many seniors are being caught completely off guard by it. The Bank Secrecy Act requires every single bank, credit union, and financial institution in the United States to automatically file what's called a currency transaction report. People usually call it a CTR. Every single time a customer deposits, withdraws, or transfers cash in an amount that's over $10,000 in a single day, your bank does not ask for your permission to do this. They don't warn you ahead of time. They don't send you a letter afterward. They simply file the report directly with the Financial Crimes Enforcement Network, which is a bureau of the United States Department of the Treasury, and that report goes straight to the federal government automatically, every single time. Now here's something that most people assume. They think that if they're not doing anything wrong, then this rule doesn't affect them. And that sounds reasonable, but the reality is a lot more complicated than that, especially for seniors. Here's why. Many older Americans receive large lump sum payments that are completely legitimate. Things like life insurance payouts after a spouse passes away, proceeds from selling a home or a piece of property, pension distributions, inheritances from family members, legal settlements, and sometimes people simply take a large amount of cash out of savings because they want to make a big purchase, help a family member, or they just feel more comfortable having cash in their hands. All of these things are legal. All of them are normal. But the moment any of these transactions touches $10,001 or more in cash in a single day at your bank has already filed that federal report. And now, your name is in a government database, not because you did anything wrong, just because the number was over $10,000. Now you might be thinking, okay, fine. If I did nothing wrong, who cares if there's a report? But here's where it gets more complicated and honestly a little bit frustrating. The IRS and other federal agencies use those CTR reports as triggers. They look for patterns. They look for unusual activity. And sometimes even perfectly innocent transactions can trigger a deeper look into your finances. The IRS might want to see where that money came from. They might want to verify that you paid taxes on it. They might flag your account for additional review. And for a senior who's already dealing with Medicare, Social Security, a fixed income, and the stress of just managing daily life, the last thing you need is a letter from the IRS asking you to explain your financial activity. That process alone can cost you time, stress, money, and accounting fees. And in some cases, it can even affect your eligibility for certain income-based programs. But here's where things get even more serious. And this is the part that far too many seniors have never heard of. There's a concept called structuring, and it's actually a federal crime. Structuring means that you intentionally break up a large cash transaction into smaller amounts, specifically to avoid triggering that $10,000 reporting threshold. For example, let's say you have $30,000 in cash that you want to deposit, and someone tells you, hey, just deposit $9,000 today, then $9,000 next week, and $9,000 the week after that. Problem solved, right? Wrong. That's structuring, and structuring is illegal under federal law. Even if the money is completely clean and you earned every single dollar honestly, it doesn't matter. The law says that deliberately breaking up transactions to stay under $10,000 is a crime in itself. Banks are actually trained to look for this kind of pattern, and if they spot it, they file what's called a Suspicious Activity Report, a SAR, and that goes straight to federal investigators. There have been real cases where seniors, farmers, small business owners, and regular everyday Americans had their bank accounts completely frozen and their money seized by the federal government, not because they were guilty of any underlying crime, but simply because they had an unexplained pattern of deposits just under $10,000. The government uses a process called civil asset forfeiture, which allows them to seize money they suspect is linked to illegal structuring, and you have to fight in court to get it back. That process is expensive, stressful, and can take months or even years. For a senior on a fixed income, that's potentially devastating. And in many of these real-life cases, the people involved had no idea they were doing anything wrong. They thought they were just being smart by making smaller deposits. They had no idea that breaking up deposits was its own separate federal crime. So why are seniors particularly vulnerable to this in 2026? There are actually a few reasons. The first is that many older Americans grew up in an era where people kept large amounts of cash at home or moved money around in physical form much more often than younger generations do today. Cash was just part of everyday life. You got paid in cash. You saved in cash. You gave cash gifts at weddings and graduations. The idea that handling your own money in cash could somehow attract federal attention feels completely foreign to many seniors. The second reason is that a lot of seniors are receiving larger than usual financial inflows right now. Baby boomers are inheriting money from their own parents who lived through the Great Depression. Many are selling off real estate in a market that has seen dramatic price increases over the past several years. Some are receiving life insurance payouts or settling legal claims. All of this creates a situation where large sums of money are moving in and out of bank accounts in ways that might look unusual to an automated banking system, even though everything is completely above board. The third reason is that many seniors are helping their adult children or grandchildren financially. Maybe a grandson needs help with a down payment on a house. Maybe a daughter is going through a divorce and needs some emergency funds. So grandma goes to the bank, pulls out $15,000 in cash, and hands it to her family member. That withdrawal just triggered a federal report. And if grandma then turns around and makes a few smaller withdrawals over the next couple of weeks to give out more cash gifts, a suspicious activity report might also be filed. The family had the best of intentions, but the federal reporting system doesn't know or care about intentions. It only sees numbers and patterns. Now let's talk about what you should actually do if you need to move large amounts of money around. The good news is there are smart, legal, and completely safe ways to handle large financial transactions that don't create unnecessary attention or risk. The first and most important thing is to simply use the banking system the way it was designed to be used. If you need to deposit a large sum of money, deposit it all at once. Don't try to break it up. A single large deposit that triggers a CTR is much less suspicious than a pattern of deposits that look like they're designed to avoid one. A CTR by itself is not an investigation. It's just a record. But a pattern that looks like structuring is what actually triggers deeper scrutiny. The second thing you should do is keep documentation. If you receive a large sum of money, an inheritance, a home sale, an insurance payout, a legal settlement, keep all the paperwork. Keep the copy of the check. Keep the settlement letter. Keep the real estate closing documents. Keep anything that shows where the money came from and why you received it. If the IRS ever asks you about a large deposit, being able to hand them a clear paper trail makes the whole thing go away quickly and cleanly. It's when people can't explain where money came from that simple inquiries turn into serious problems. The third thing is to consider using wire transfers or checks instead of cash for large transactions. Wire transfers and checks create their own paper trail automatically. When you wire money to someone, both banks have a record. When you write a check, both the payer and the recipient have documentation. This is much cleaner and safer than moving large amounts of cash around. Cash is anonymous by nature, and that's exactly why the federal government watches it so closely. The moment you switch from cash to traceable payment methods, you make your financial life much simpler and much less likely to attract any kind of federal attention. Fourth, and this is especially important for seniors who are giving money to family members, make sure you understand the annual gift tax exclusion. In 2026, you're allowed to give up to a certain amount per person per year as a gift without triggering any gift tax reporting requirements. Now that number changes from year to year, so you absolutely need to check with a tax professional to get the current exact figure. But the point is, there's a legal and structured way to give money to your children, grandchildren, or anyone else without creating a tax mess. If you're planning to give large sums to family members, talk to a tax advisor first. A little planning goes a long way. Fifth, if you're dealing with a particularly large financial event, like selling a house, receiving an inheritance, or getting a large pension distribution, it's worth having a one-time conversation with a CPA or a certified financial planner before the money hits your account. They can help you plan how to receive the money, where to put it, and how to document everything properly so that the transaction is clean, clear, and fully compliant from the very beginning. That 1 hour of professional advice could save you months of headaches down the road. Now let's talk about something that's been growing as a major concern for seniors specifically in 2026, and that's the intersection of this $10,000 rule with Social Security and Medicare. Here's what a lot of people don't realize. If the IRS starts looking into your financial activity because of a large cash transaction, even one that's totally legal, they may end up reviewing your overall financial picture. And if they find that your income or assets are higher than what's been reported, that can affect your eligibility for certain programs. For example, if you receive Medicare and specifically Medicare Part B or Part D, the premiums you pay are actually income-based. Higher income means higher premiums. If the IRS determines that a large sum you received should have been counted as income in a prior year, they could potentially adjust your Medicare premiums retroactively. This is rare, but it's not impossible. Similarly, if you're receiving supplemental security income, which is SSI, not regular Social Security, that program has strict asset and income limits. SSI is specifically for low-income seniors and people with disabilities. If you receive a large sum of money and don't report it or handle it correctly, and then the government finds out through banking reports or tax records, you could lose your SSI eligibility. Even temporarily losing SSI can be financially devastating for someone who depends on it for their basic living expenses. This is yet another reason why understanding how large cash transactions work with federal reporting systems isn't just interesting information. It's actually critical financial self-defense for seniors. Let's also talk about the emotional and psychological side of this because it's real and it matters. A lot of seniors feel embarrassed or even ashamed when they receive a letter from the IRS, or when their bank flags their account for review. They think they must have done something wrong, even when they did nothing wrong at all. And unfortunately, that shame and fear sometimes leads people to make worse decisions, like not responding to the IRS communication, or trying to move money around even more to avoid detection, which ironically makes the situation significantly worse. If you ever receive any kind of communication from the IRS about a financial transaction, don't panic, don't ignore it, and don't try to handle it alone. Get a qualified tax professional involved immediately. In most cases, if the underlying money is legitimate and you have proper documentation, these situations resolve quickly and without major consequences. But ignoring IRS correspondence is never the right answer. Another thing worth mentioning is that scammers absolutely know about senior anxiety around IRS issues and bank rules, and they exploit it ruthlessly. Every single year, millions of seniors receive fake phone calls, fake emails, and fake text messages claiming to be from the IRS. These scammers tell seniors that their bank account has been flagged, that there's a warrant out for their arrest, or that they need to immediately send money or gift cards to avoid prosecution. This is always, 100% of the time, a scam. The IRS does not call you out of the blue. The IRS does not demand gift cards. The IRS does not threaten immediate arrest over the phone. If you get a call like this, hang up. If you get an email like this, delete it. And if you're genuinely worried about your IRS status, go directly to irs.gov or call the official IRS number yourself. Never call back a number that a suspicious caller left for you. Now you might also be wondering, what about online banking and digital transactions? Does the $10,000 rule apply to those too? The short answer is yes, absolutely. The Bank Secrecy Act applies to all forms of currency transactions, not just physical cash. Electronic transfers, wire transfers, and even certain cryptocurrency transactions are subject to similar federal reporting requirements. In fact, regulations around digital financial activity have been getting stricter, not looser, in recent years. So if you're doing large transactions online, the same general principles apply. Keep documentation. Use traceable methods. Don't try to break up large transfers into smaller ones to avoid detection. And when in doubt, talk to a professional. Something else that's become increasingly relevant for seniors in 2026 is the rise of peer-to-peer payment apps like Zelle, Venmo, PayPal, and Cash App. Many seniors have started using these apps to send and receive money from family members. And while these apps are convenient, they also come with their own reporting rules. Starting in recent years, the IRS has required these platforms to issue tax forms for users who receive payments above certain thresholds. If you're regularly receiving payments through one of these apps, even from your own children or grandchildren who are simply paying you back for things, it's worth understanding how those payments might look on your tax record and whether you need to report them as income. Again, a quick conversation with a tax professional can clear this up in no time. Let's circle back to the big picture here because it's important. The $10,000 rule, the Bank Secrecy Act, and the Currency Transaction Report requirement is not designed to punish honest people. It was originally created to help the federal government track illegal activity like drug trafficking, money laundering, and organized crime. The problem is that the same system that catches criminals also catches everyday Americans who simply don't know the rules. And seniors, who often have decades worth of savings, real estate equity, pension funds, and family financial responsibilities, are especially likely to find themselves involved in large transactions that they've never had to think about before. The rule itself is not the enemy. Ignorance of the rule is. The most powerful thing you can do right now is to get educated, get organized, and get professional guidance when you need it. Talk to your banker about how they handle large transactions. Talk to your CPA about your specific financial picture. Talk to a financial advisor about the best ways to manage and move large sums of money in ways that are clean, documented, and compliant. If you have adult children who help you manage your finances, share this information with them, because sometimes well-meaning family members give seniors advice like, just break it up into smaller deposits without knowing that this is actually a federal crime. That kind of advice, even when it comes from a loving place, can create serious legal problems. And here's the final thought I want to leave you with. You worked hard your entire life for the money you have. You paid your taxes, you followed the rules, you saved carefully, and you made sacrifices so that you could have financial security in your later years. You absolutely deserve to enjoy that security without fear and without confusion. But protecting what you've earned requires knowing the rules of the financial system you're operating in. The $10,000 bank rule is one of those rules. It's real, it's enforced, and it affects real people every single day in ways they never expected. Now you know about it. Now you can make smarter decisions. Now you can protect yourself, protect your family, and move through your financial life with confidence and clarity. Share this video with every senior you know, a parent, a grandparent, a neighbor, a friend from church or from your community, because this is exactly the kind of information that doesn't always find its way to the people who need it most, and knowing it truly can make all the difference.